Stop guessing entries and trade the way the banks does. A lot of you have noticed that sometimes analyzing from higher time frames, trying to point out your entry points, along the way you get things messed up. Like you'll be watching your POI on a lower time frame, like 15 minutes or 5 minutes, and you'll be seeing that your POI, your highlighted POI is about the zone itself is about 30 pips or more, and this actually leads to some traders jumping into the market early, which is during the liquidity sweep of the market. And it will actually discourage you along the way, but not to worry, because in this video I've taken my time and I've made sure I'm going to give you guys the blueprint of trading zones, okay, and how you can stay profitable with it. And also I'm gonna show you the 3 types of zone, which is obviously written out in my screen here, and how to implement it in your chart. So make sure you stay to the end of this video, because I trust and I know that you will not afford to miss any part of this video. So stay to the end. So let's get started, guys. So now we're talking about zones, all right? And in zones, we all know what zones are. That is the area that we expect price to react. Okay, it can be an order block, it can be a demand zone, etc. and etc. But now, how do you classify zones? This is the next part. So many traders don't even know that there are 3 types of zones. All they know is that an order block is the first bullish candle before a bearish movement, or a bearish candle before a bullish movement, just like that. But now inside that order block, we have 3 types of zones when you're marking out your order block. And now I'm going to explain. The first one is called range zone. Okay, just you can see on my left side of the screen, I have taken my time to draw an illustration that will actually make us grab this concept very, very quickly. So here is the range zone. So now this implies judging and taking 3 candles before the last bearish candle. Okay, now normally it should be this one, okay, which is the normal order block people use it. But trust me, there are some people that uses this type of range zone pattern. Okay, all right. So now this is a range zone pattern kind of trading. And coming to the second one, we have the pivot zone. So now this pivot zone, you can see that it is the last candle that has been taken. Okay, and don't forget, I'll also tell you the probability ratios of all these zones and the ones that actually yield mostly, and how you can trade them, how you can apply them in your analysis. Because trust me, if you apply them wrongly, you can either miss that trend, or you become a soup for the market. That means you become a liquidity for the market to sweep before tapping into the right POI zone and start heading your way. And we know how that feels anyway, because it feels terrible. It feels very, very terrible. So now, and the last here is fractal. And you can see that on fractal, we didn't highlight the body of the candles, but instead we only highlighted the wick. Why? Because it is fractal. Okay, it is very, very fractal. So the wick is only highlighted. So now let me start like this. You see, this is how it goes using all this in your analysis. A fractal can be a higher time frame depending the type of trader you are. If you're intraday, let's say you analyze from 4 hours, and on your 1 hour you can get your pivot zone, and on 15 minutes you can get the range. You see, so now what so many traders does is that they try to push, or they try to force the market to do their wish. And sometimes, trust me, you find out that the market does not do anybody's wish. Okay, so all we have to do is follow the rules. All right, so now if you don't know about pivot zone, range, fractal, trust me, you can be highlighting a range zone on a 4-hour time frame, and that means your SL is going to be huge. Because trust me, 3 candles on 4 hours time frame, when you come down to 15 minutes for your POI as an intraday trader, you're going to have a very wide risk to take, okay, on that trade. And judging that, you see that you will not be making anything probably because your risk is too much. Your risk is too much because of your SL. But if you understand the range and make range zones useful in your analysis, you will now understand where to implement them. Alright, so fractals are to be used on higher time frames, while range and pivot are to be used on lower time frames. I will tell you their abilities when you make use of them. Now, starting with the range, and you can see that the range will expose your account too early in the market. All right, just as you can see that maybe this market can maybe go to the extent of reaching to this other block mainly, and you can see all this while you are running in loss. Okay, your account is bleeding. If you don't have enough capital, it may likely take you out, or maybe you can actually close out of fear or something like that. So the range zone exposes your account, all right, too early in the market. So that's just one thing with range zone. But now that I've shown you how to use those, I believe you can filter out and trade the one that you know you can literally work well with, right? Yes, so let's head on to the next one. And the next one is bearish pivot zone. So here is the pivot zone pattern of trading, and which I consider the best, all right, because this pivot zone literally does not expose the account too much, and it makes you also not lose potential entries, good entries, all right. So you're being you're being conservative, okay. So pivot zone is the best to me, and I love trading pivot zone, all right, because it's actually 100% of an order block example. You know, the last bullish candle before the bearish candle, the last bearish candle before the bullish candle, something like that. So, and most of the time, 80%, 70%, or even 90% of the time, market tends to respect this rule in the financial industry. So I would highly recommend using pivot zone instead of using range if you have been using range. But I'm not trying to justify or command you on what kind of style of zone you are going to use. But don't forget, this video is all about educational purposes only. So now let's head on to the third zone. Here we get the fractal, just like I've explained. We all know what the fractal is the wick, the highest point or the lowest point of the market. So now here is a catch for fractal zones. Fractal zones actually is risky because sometimes the market may not actually seek that extent level of the market before reversing. So maybe it can do something like this, heading into the body of that candle and grab. So far it has accumulated enough liquidity it needs. It can decide to go the other way and leaving your orders not filled. And most of the time, you find out that if the market goes to this extent, just using like FIB, you see that this is almost close to 100% reversal. So all they have to do is just to push this market up here and sweep everybody out using this high as their next liquidity sweep, because this is almost to the high of the market. So I don't like using one is for missing entries, potential entries. Then second is, risking my SL along the way. So if you find this video very interesting and you love the information you get, don't forget to share to your loved ones and to your friends so that they also stay profitable and enjoy the knowledge you have gotten. And also don't forget to click on the notification button, click on the share, and also follow my page for more videos like this. Don't forget to drop your comments also in the comment section. I'll be seeing you guys in my next video. Till then, stay safe in the financial market.